Hello, everyone. Welcome back to the Weekend Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, hit that subscribe button for all the latest content from us. A lot to talk about today. We're going to run through the equity markets, this concept of strength begetting strength. We're going to talk about the last 6 months, so really the first half of this year versus the last decade. A rising tide lifts all boats. What a turnaround for the markets. We're going to discuss that. The jobs report showing, once again, I'd say a cooling of the labor market, a slowdown, but still better than expected, I would say. And for that reason, we're going to say goodbye to the July rate cut. We'll talk about the market's expectation there. Declining dividend yields in the S&P 500, lowest levels since 2000, and we'll end with something positive, as we always do, and that would be more affordable rents. Let's start out with the U.S. equity markets. Strength begets strength, and that wasn't a concept that we were talking about early in the year. Just a few months ago, if we look back to April, what we were talking about was one of the worst starts to a year in history, with the S&P 500 down over 15% on the year as of April 8th. And since then, what we've seen is one of the most remarkable comebacks in stock market history. You can see the trajectory here. I'm comparing this year's path to all of the other paths we've seen since 1990. Total return for the S&P 500 is now up 7.5% on the year, and it's actually above the average year at this point in time, which is about a 5% gain. So what a difference a few months makes. Now we're talking about an above average year when we were talking just a few months ago about one of the worst starts to a year in history. So how did we get here? We had this enormous rally. Let's just put this in context here. Going back to 1989, I looked at the strongest 13-week rallies that we've seen in the S&P 500, and now you have it here, 24% gain off of where we were 13 weeks ago for the S&P 500. That's good for eighth biggest in terms of returns, and you can see the other dates on this list here. You got 2009 off of the March 2009 lows. There's 3 of those examples here. You got the 2020 lows, 2 examples there. The rip-roaring comeback after the 1998 bear market. And you have this one data point in 1997 as well. So in rare company here. And what's interesting is if you look at the next year following these huge comebacks in the markets, these huge short-term advances, what you tend to see is strength begetting strength, meaning the market tends to be higher over the next year with above average returns in the past. So you can see here, with the exception of this 1991 example, which is just shy of 10%, all the other data points are in double-digit returns over the next year. Does that mean that's going to happen this time? Absolutely not. But what should you take away from this chart? That normally, when you have a huge stock market advance, you tend to see further gains over the next year. So let's go to number 2 here, talking about the last 6 months, which is really the first half of this year versus the last decade. And in the last 6 months, we've seen enormous outperformance from international stocks. I'd say among the biggest stories this year so far, other than the huge comeback this year, 13% outperformance in the first 6 months of this year. And you can see, looking back in the past 30 years, we've only seen bigger outperformance a few times. We saw it back in 2009, and before that, you have to go back to the late 1990s. And if we look at this year's return through the first half of the year, we can see international stocks here, so excluding the US and the MSCI World Index, up 19.5% versus a 6% return for the S&P 500. So an enormous differential, one of the biggest we've seen going back in the last 30 years. Does this erase that huge outperformance we've seen over the last decade? Absolutely not. If we look at, as of June 30th, the last 10 years for the S&P 500, what you could see is 259% for U.S. stocks and international stocks are up 100%. So still a very, very wide differential here over the last decade, even though the first 6 months of this year we've seen a bit of a reversal in this trend. So going forward, who knows what's going to happen, which is why you should be diversified in your portfolio. And if you're thinking about the second half of the year and you want a second look on your portfolio or your financial plan, now's a perfect time to reach out to us at Creative Planning. Go to creativeplanning.com/Charlie to get your free wealth path analysis, where we'll help you look through your portfolio and your plan, making sure you're on the right path to financial independence. At Creative Planning, we're in all 50 states, so we likely have a location right near you. We're abroad as well. So reach out to us today at creativeplanning.com/Charlie. We have over 350 billion in assets under management and advisement, and we're here to help. Reach out to us, creativeplanning.com/Charlie. A rising tide lifts all boats. That is really the story right now across pretty much all markets. And we couldn't say that up until this point in the year because there were things that were down on the year, but no more. And just looking at the S&P 500, I just want you to visualize here what a dramatic comeback it's been. 21% decline from the February high to the April lows. One of the fastest bear markets in history. It was actually the second fastest after the 2020 decline. And you can see off of those lows, 30% gain in the S&P 500 off of those lows. Second fastest recovery I could find in terms of the S&P 500 taking back its all-time high after a bear market. Only the 1982 bear market was faster off of the October lows that year. So 30% advance, new all-time highs. We now have hit 7 so far this year, closing once again today at an all-time high. That follows 57 last year. So last year, 5th most in history. This year, it looked like we were only going to get a few after that bear market, but here we are hitting all-time highs once again. And the question we often get following all-time highs is, what tends to happen after you hit an all-time high? And the simple answer, based on the data, is you tend to see more all-time highs. And you can see that here, looking ahead, 1 month, 3 months, 6 months, 1 year, the returns are still positive for the S&P 500, average return over the next year of around 10%. So a rising tide lifts all boats. This chart really illustrates that right here. Looking at all of the major asset classes, you can see in the 2025 column, I have this sorted from return highest to lowest. And up until this point in time, there was always something in the red, and really small caps have been lagging the entire year. They're still lagging, but they inched into positive territory this week for the first time. So 100% of asset classes right now in positive territory. We haven't seen that for a calendar year since 2019, so we'll see if that holds. But incredible strength across the board. So if you're in a diversified portfolio, you're definitely winning this year in many different areas, contributing, as we talked about, that haven't been leading in the past. And you can see the international ETF here, the EAFE ETF, up 20%, very strong. And we're seeing just contributions across the board, different asset classes from bonds to stocks, convertibles, preferred, everything now in positive territory. And looking at the returns off of that April 8th closing low for the S&P 500 sectors, you can see here, every single one of them positive. So everything contributing, but the big standout has been what was lagging in the first part of the year, especially during that bear market, was the technology sector. And you could see it has come back with a vengeance. 43% gain off of that April 8th closing low for the technology sector ETF, the XLK. So wide outperformance versus the S&P 500 over that period of time. The big laggard has been the healthcare sector, also defensive sectors, utilities, and consumer staples lagging as well, as you might expect during this huge recovery, which really the markets are saying, well, they were saying, well, it seems likely we're going to recession. And then the minute that changed, you saw the cyclical sectors start to advance and recover, and the defensive sectors on a relative basis pull back. So let's talk about the jobs report. And I'm calling it a jobs market slowdown because the overall growth rate is down. But if we look at this particular report, it actually beat expectations. 147,000 jobs were created in the month of June, and that was above expectations for 110,000 gain. And also the prior few months were actually revised higher. So in terms of that particular number, definitely a beat, and the trend is still up. 54 now consecutive months of jobs growth in the US. That's the second longest streak in history. But digging into the numbers, some interesting data points here. I think a little bit surprising that government was the biggest sector contributing to that jobs number for the month of June. About half of the jobs coming from the government sector, 73,000. And no, this is not from the federal government, which actually saw a reduction in jobs once again in the month of June. This was coming from state and local government jobs. So if you take that out, then you have weak overall private sector growth, I would say, for the month of June. The question for July is this a one-off, or are we going to see this happen once again? I don't expect to see the government job number to be leading once again. The question is, are we going to see some of the private sector numbers rebound for the month of July? If we look at the unemployment rate, this is another strong data point, better than expectations. People were not predicting that this was going to go down. This is something that the Fed talks about frequently in its evaluation of the labor market. So definitely would be influencing them in terms of their decision in July. It moved down to 4.1%. So what we're seeing now is the lowest unemployment rate since February. So less urgency for the Fed to cut interest rates, as I'll talk about in a little bit. But what about that slowdown? Well, that's really revealed in the next few charts here. For looking at payrolls year over year, 1.1% growth rate, slowest rate we've seen in quite some time. The historical average is about 2%. So definitely a slowdown in the number of new jobs that are being created. If we look at the ADP employment report that we got this week, we saw actually a decline in private sector jobs here. Not a huge decline, but 33,000 jobs. First negative print since March 2023. So really confirming the weakness in the private sector that we saw in the non-farm payroll report. And once again, this is really the most important leading indicator for the jobs market to watch, in my opinion, would be continued jobless claims. So people who have filed for unemployment and are still claiming unemployment, presumably because they're having a difficult time finding a new job, that's at its highest level since November 2021. So we'll see if this continues to go up. Obviously, if it were to reverse course and start coming down, that would be good news. But for now, this is the indicator I'm watching most closely. An interesting trend that we're hearing more about, I talked about it last week in terms of the white-collar workforce reductions. 1 in 5 companies in the S&P 500 have fewer employees today than they did 10 years ago. You can see some of the big names in here that are on that list: McDonald's, General Motors, Walmart, Procter & Gamble, and Bank of America. So interesting trend here over the past decade that actually seeing these huge companies have fewer employees than they did 10 years ago. So let's talk about how that labor market report is likely to influence the Fed's decision in terms of their July meeting. They're going to meet on July 30th, so the end of the month. They're going to get more data for sure. Before that point, they're going to get a CPI report and a PCE report. But in terms of the employment part, this is the data that they're going to go with. And what the market essentially said after this payroll report is take that any thought of a cut off the table here. 95% chance now the market's pricing in that the Fed won't do anything in the month of July. And you can see that's up from about 79% just a week ago. So big increase in just 1 week in terms of the market saying the Fed's going to still wait for another meeting before they cut interest rates. And in terms of that inflation number, we're not going to get that. We're not getting that next week, but we're going to get it the week after. Once again, it seems pretty likely that that's likely to tick up. If we're looking at core CPI, 2.77% was the last month's reading, and 2.35% was the overall reading. And the Cleveland Fed is projecting core CPI to go up to 2.95% and overall CPI 2.64%, with core PCE coming in around the same. So if we're putting all the pieces of the puzzle together, it seems like the Fed will have no urgency to cut interest rates in July. They're going to continue to say that the tariff situation is uncertain, and perhaps we're going to see price increases in the back half of the year. You're hearing more companies talk about this. Nike was a prominent one that recently talked about higher prices due to the tariff situation. So they're going to point to that, and they're going to point to a stronger than expected labor market. So no urgency to cut because the unemployment rate's still at 4.1%. And they're going to point to this number here, which is showing CPI is going up, not down versus the prior month. And their core PCE number, which is the Fed's preferred measure of inflation, still is not at the 2% target that the Fed has, still well above it, and it never actually got there. So if you put all that together and you look at the odds of recession, which have plummeted over the past few months, back in May, Polymarket odds were above 60%. Now we're down to 22%, lowest we've seen in months here. You put all that together, the Fed's going to, I believe, say when they meet in July, there's no need to cut interest rates. So let's talk about dividend yields. Declining dividend yields here for the S&P 500. That's not because dividends are going down. It's because the price of the S&P 500 is going up way more than that increase in the dividend yield. So the actual dividend. So if we look at dividends per share for the S&P 500, you could see continuing to hit record highs on a trailing 12-month basis. They're actually 7% higher than a year ago, which is pretty strong growth over the past year. But if we look at that yield, the reason it's going down is because the price, S&P 500, after that huge recovery that we saw, has gone up more than that increase in the dividends. And so what we're talking about here at 1.25%, this is the lowest dividend yield for the S&P 500 since 2000. And a lot of people will talk about dividend yields as a valuation metric. So similar to what I've been talking about in terms of price to earnings ratios or the CAPE ratio, which is well above the historical average. This would be the flip side, the yield on the S&P 500 near its lowest levels ever. You have to go back to 2000. And some people might be asking, well, what about buybacks, which is very important today? A lot of companies choose to buy back shares instead of issuing a higher dividend. And yeah, this would be higher, but the chart would look very similar. It'd still be the lowest yields that we've seen in a long, long time. Might bump it up to about 2%. I don't yet have data for the second quarter in terms of buybacks. When I have that, I'll illustrate that chart. But same theme, essentially, even though buybacks would push this yield to be higher, it's still among the lowest level that we've seen in history. Okay, let's end with something positive, as we always do, and that would be more affordable rents. This is something I've been talking about every month, and that's because every single month, rents in the U.S. overall are becoming more affordable, and that's because rental prices are going down on a year-over-year basis. We saw that yet again for the month of June, negative 0.6%. That was the 25th consecutive month with a year-over-year decline in rents. And we look at the reason for this. It's very simple: supply and demand. The supply numbers continue to increase here. The vacancy rate in the U.S. in terms of rental apartments, 7% now, the highest on record, with data going back to 2019. So very good news for anyone in the rental market. It's likely that rents will be capped as long as we have this high supply situation. And why are rents becoming more affordable? It's not just the nominal price declines. It's also the fact that hourly earnings, wages, are outpacing that increase or actually decrease in rent. So what we've seen now since January 2020, it started out bad. It started out with U.S. rents skyrocketing during that inflationary period, but they peaked in 2022, and you can see they were well above the increase in hourly earnings. And since then, people's wages have continued to go up. The payroll report we just got showed an increase of 3.7% over the last year. And you can see since January 2020, we're seeing 28% increase in people's wages, 21.6% increase in U.S. rents. And that differential is making the rents more and more affordable. So this is very good news, a good trend. Hopefully continues, because this is the biggest component of people's budgets, is how much they spend on housing. And now we've gone essentially 3 years with rents lower than where they were 3 years ago on a nominal basis when they peaked, and people's earnings, of course, continue to go up and up and up. So great sign. Hopefully this continues, and we'll end it right there. Thank you everyone for watching the Week in Charts. If you're watching this on YouTube, hit that subscribe button for all the latest content from us. Have an awesome holiday weekend. Happy 4th, everyone, and I'll see you next time on the Week in Charts.